why BlackRock just transferred $2.1 trillion out of America, and what it means for you. Sounds like just another financial headline, but it isn't, because money doesn't move like this by accident, and it doesn't move like this without a reason. While markets hit records, while politicians speak confidently, while the public stays distracted, the largest asset manager on earth has been quietly repositioning capital at a scale not seen in generations. No press conference, no emergency announcement, no warning bell, just behavior. And in financial history, behavior always comes before crisis. The question is not what moved, it's why it moved, and what phase of the economic cycle this kind of movement has always signaled. Right before everything changes, they did not announce it on television, they did not call a press conference. There were no emergency meetings broadcast to the public, but the movement happened, quietly, systematically, and at a scale that almost never appears in headlines. BlackRock, the largest asset manager in the world, with influence stretching across governments, pensions, corporations, and central banks, began transferring massive amounts of capital out of concentrated U.S. exposure and into international, real asset, and non-domestic structures. Not millions, not billions, trillions. And in financial history, movements of this size are never cosmetic. They are never routine. They are not just rebalancing. They are signals. BlackRock does not operate like a trader. It does not chase short-term profit. It manages long-duration capital, pensions, sovereign funds, insurance reserves, and institutional money that must survive decades, not quarters. When an institution like this changes direction, it is not reacting to headlines. It is positioning ahead of structural change. The business community often focuses on what leaders say, but serious capital studies what leaders do. Statements protect confidence. Capital protects survival. And right now, behavior is speaking louder than any official reassurance. For more than 70 years, the United States has been the center of global capital gravity. The dollar has been the world's reserve currency. U.S. Treasury bonds have been treated as the risk-free foundation of the global system. American markets have absorbed foreign savings, foreign trade surpluses, and foreign central bank reserves. This created a simple reflex across global finance. When uncertainty rises, money moves into America. But what happens when that reflex begins to weaken? What happens when the world's largest asset managers begin spreading capital outward instead of pulling it inward? That is the question serious investors are now forced to confront. BlackRock sits at the core of modern finance. It advises governments. It builds risk models used by central banks. Its systems track markets, currencies, bonds, commodities, and institutional flows across nearly every major economy. When it changes long-term allocation patterns, it is not expressing an opinion. It is responding to data. Capital flows are one of the few signals in economics that are difficult to fake. Governments can change definitions. Institutions can adjust narratives. Media can shift attention. But trillions of dollars cannot quietly move unless powerful incentives are forcing them to move. And incentives in finance always come from risk. Not visible risk, structural risk. The kind that builds quietly under strong surface performance. The kind that does not show up first in stock prices, but in balance sheets, capital structures, and cross-border positioning. To understand why this matters, it is important to separate financial noise from financial behavior. Retail markets move on emotion. Institutions move on exposure. Retail traders chase opportunity. Institutions manage survival. Retail investors react. Institutions anticipate. When institutions reposition capital, they are not predicting tomorrow. They are preparing for conditions that make current structures less reliable. In past financial transitions, this phase always looked the same. Markets remained strong. Innovation continued. Optimism dominated headlines. Confidence stayed high. But underneath, large capital quietly reduced dependence on the existing core, not because collapse was tomorrow, but because stability was no longer guaranteed. This phase rarely feels dramatic while it is happening. It feels technical. It feels procedural. It feels like portfolio language, until later, much later. Then history relabels it. Capital flight, loss of confidence, systemic transition. But at the time, it always arrives disguised as normal allocation. The reason this moment matters is not because one firm moved money. It matters because BlackRock does not move alone. Large asset managers operate inside the same risk environment. They read the same debt markets. They track the same funding pressures. They watch the same currency settlements. They see the same liquidity mechanics. They compete in performance, but they align in survival. When the largest among them begins to widen its geographic and structural exposure, it suggests that the old assumptions are no longer sufficient. And those assumptions have defined global finance for most living professionals. Assumptions like U.S. debt will always be easily absorbed. U.S. markets will always attract excess capital. The dollar will always dominate settlement. Liquidity will always be available in stress. Government bonds will always stabilize portfolios. These beliefs are not laws of nature. They are historical conditions, and history shows that such conditions do not end loudly. They end quietly first. They end with adjustments, with diversifications, with hedges, with subtle reductions, with behavior that only looks important in hindsight. The business community often underestimates this phase because it does not feel like crisis. It feels like optimization, like modernization, like global expansion. But structural transitions never announce themselves as danger. They announce themselves as strategy. This is why BlackRock's repositioning deserves analysis beyond headlines, not as a scandal, not as a prediction, but as a data point inside a much older pattern. Across 5 centuries of financial history, every dominant financial center followed the same sequence. First came attraction, then overextension, then quiet repositioning, then resolution. The third phase was always the least visible. It was the phase where the smartest capital stopped concentrating and started spreading. Not because collapse had arrived, but because the margin for error was disappearing. The purpose of this series is not to forecast dates. It is to understand conditions, because conditions shape incentives, and incentives shape capital. And capital moves before systems change. If the largest asset managers on Earth are no longer behaving as if American concentration is sufficient protection, then the strategic environment has already shifted. The real question is not whether markets are strong today. The real question is why the guardians of long-term capital are preparing as if tomorrow may not resemble yesterday. And that question leads directly into the structure of the system itself, the pressures building beneath it, and the historical phase such behavior has always belonged to, right before financial orders change. To understand why institutions would begin transferring capital outward, it is necessary to look beneath markets, beneath headlines, beneath political debates, and into the structure of the system itself. Surface performance does not reveal structural health. In late-stage financial systems, strength is often visible at the top, while stress accumulates underneath. The modern U.S. financial system is built on a foundation that did not exist a century ago. It is a system defined by permanent debt expansion, monetary intervention, and asset price support. These tools created extraordinary growth. They also created deep dependence. Since the dollar became the global reserve currency, the United States has enjoyed a unique advantage. It could borrow in its own currency. It could fund deficits without facing immediate external discipline. It could absorb global savings into its bond market. It could expand credit faster than productive output. This privilege allowed the system to grow far larger than its underlying economic base. At first, this was an advantage. Later, it became a requirement. Today, the U.S. government does not simply use debt. It depends on it. Deficits are no longer temporary responses to crisis. They are permanent operating conditions. Each year requires new borrowing to pay old obligations. Each cycle requires larger interventions to stabilize markets. Interest is no longer a policy variable. It is a structural burden. As total debt rises, interest costs rise with it. Even small rate increases now produce massive payment obligations. This creates a narrow corridor where the system must remain. Rates cannot fall too low without destroying the currency, and they cannot rise too high without destabilizing the debt structure. This is not a political condition. It is a mathematical one. At the same time, asset markets have become deeply tied to liquidity support. Equity prices, bond prices, and real estate valuations no longer move mainly on productivity. They move on financing conditions. Low rates encourage borrowing. Borrowing inflates asset prices. High asset prices support consumption. Consumption supports growth. This loop worked powerfully for decades. But loops that rely on expansion eventually reach scale limits. When total debt grows faster than income, the system becomes more sensitive to stress. Growth becomes less organic. It requires support. Each intervention must be larger than the last to achieve the same effect. Over time, this shifts the character of the economy, from production to finance, from income to asset inflation, from saving to leverage. This environment rewards speculation over stability. It increases paper wealth while weakening purchasing power. It produces high valuations alongside high vulnerability. Late-stage financial systems often look strongest in this phase. Markets reach records. Innovation continues. Capital feels abundant. But resilience quietly declines, because resilience depends on margin, and margin disappears when leverage dominates. In earlier phases of reserve currency systems, debt was a tool. In later phases, debt becomes the system, and systems built on expanding debt face one unavoidable pressure. They must continuously attract buyers of that debt. This is where reserve status becomes critical. Global demand for dollars and treasuries has historically absorbed U.S. deficits. Foreign central banks accumulated reserves. Export nations recycled surpluses. International trade settled through dollar channels. This allowed American borrowing to expand without immediate consequences. But reserve systems are not permanent structures. They are confidence systems. They function as long as participants believe concentration equals safety. Once that belief weakens, even slightly, incentives change. Foreign buyers become more selective. Institutions diversify settlement exposure. Capital begins to seek redundancy, not exit, redundancy. In stable systems, efficiency dominates. In stressed systems, redundancy dominates. Redundancy means multiple currencies, multiple markets, multiple jurisdictions, multiple settlement paths. It is the financial equivalent of building additional supply lines. This shift does not require collapse. It only requires rising uncertainty. In recent years, uncertainty has increased across several layers of the system at once. Fiscal rigidity. Deficits persist regardless of growth. Monetary dependence. Markets rely on policy stability. Debt scale. Interest consumes larger budget shares. Political fragmentation. Coordination becomes harder. Global realignment. Trade routes diversify. Payment systems evolve. Alternatives emerge. Each of these factors alone is manageable. Together, they change the risk profile. They make concentration less attractive. They encourage dispersion. This is why large institutions analyze not only returns, but reliability. They do not ask, will this perform next year? They ask, will this remain functional across regimes? Late-stage reserve systems tend to experience the same transformation. The currency remains dominant, but its margin shrinks. Its share of trade slowly declines. Its debt market grows faster than external demand. Its central bank becomes more active. Its political system becomes more polarized. On the surface, this appears as noise. Underneath, it is reclassification from unquestioned core to managed exposure. This is where the four-stage historical framework becomes relevant. Every dominant financial center is passed through ascension. Capital concentrates, innovation accelerates, confidence builds. Overextension, debt expands, interventions grow, asset inflation dominates. Silent exodus. Institutions quietly reduce dependence, diversify risk. Resolution. The system restructures through inflation, devaluation, or crisis. The third stage is always the most misunderstood, because nothing is obviously broken, but everything becomes more sensitive. In this stage, governments continue to speak confidently, markets continue to function, growth still appears in reports, yet the behavior of large capital changes. It stops maximizing upside and starts minimizing exposure. This is not pessimism, it is adaptation. When institutions begin to place greater emphasis on jurisdictional spread, commodity linkage, and international settlement structures, they are responding to a system that is becoming less predictable. Predictability is the true foundation of reserve status. Not power, not size, not technology. Predictability, the ability to price contracts decades forward, to assume settlement reliability, to trust policy continuity. When predictability weakens, even slightly, large capital adjusts. It does not announce distrust, it expresses it through positioning. This is the environment in which BlackRock's repositioning must be understood, not as a judgment on America, but as a response to structural conditions that no longer justify single-point concentration. The pressure is not coming from markets. It is coming from the architecture of the system itself, and when architecture changes, the earliest visible effect is not crisis, it is capital migration. The next step is to observe whether this behavior is isolated or part of a broader institutional pattern. Because when many independent institutions reach the same conclusion, they are rarely responding to headlines. They are responding to structure, and that structure determines what phase the system has entered. Financial systems do not announce when they enter a new phase. They reveal it through behavior. Prices fluctuate every day. Narratives change every week. Political leadership shifts every few years. But capital behavior moves more slowly, more deliberately, and with far greater consequence. This is why serious analysts track not what institutions say, but what they quietly do. When a pension fund alters its geographic exposure, it is not chasing headlines. When a sovereign fund increases hard asset allocations, it is not reacting to media. When global asset managers rebalance across jurisdictions, they are not expressing opinions. They are responding to risk gradients. Over the last several years, a clear pattern has emerged across global finance. Institutional capital has begun reducing concentrated exposure to a single financial center and increasing exposure to diversified structures. Multiple currencies, multiple markets, multiple settlement environments. This is not an exit. It is a hedge against system dependency. But one of the clearest indicators comes from government bond markets. For decades, U.S. Treasuries functioned as the primary reserve asset of the global system. Foreign central banks accumulated them as savings. Exporting nations recycled trade surpluses into them. Institutions treated them as the foundation of portfolio stability. In recent years, that pattern has softened. Large holders have gradually reduced growth in Treasury accumulation. Some have reduced total exposure. Others have redirected reserve growth into alternative assets and currencies. The change has not been dramatic. It has been consistent. Consistency matters more than speed. In parallel, institutions have expanded into international infrastructure, commodity-linked projects, and non-US real assets. These allocations do not seek rapid appreciation. They seek insulation. Infrastructure assets produce local cash flow. Commodities anchor value outside currency systems. International real estate embeds capital into diverse regulatory regimes. These are not speculative trades. They are structural positions. They are chosen not because they outperform in perfect conditions, but because they survive imperfect ones. Another indicator lies in currency settlement behavior. An increasing share of global trade is now conducted outside the exclusive use of the dollar. Bilateral agreements, regional payment systems, and localized clearing arrangements are growing. This does not remove the dollar. It reduces dependency on it. From an institutional perspective, dependency is risk. When payment systems diversify, when trade settlement fragments, and when capital routing multiplies, the financial system becomes more distributed. Distributed systems are more complex. They are also more resilient to localized stress, but they reduce the centrality of any single node. For decades, the US dollar functioned as the dominant node. Now, capital is building alternatives, not replacing layering. This distinction matters. Financial transitions do not occur through replacement first. They occur through optionality. Capital builds options before it exercises them. This is precisely what is visible now. Asset managers have expanded global exposure. Sovereign funds have broadened asset classes. Central banks have increased non-traditional reserves. Trade blocs have explored independent settlement channels. Individually, each action appears manageable. Collectively, they form a pattern, and patterns define phases. The third phase of every reserve system transition is marked by three behaviors. First, institutions reduce single system reliance. Second, capital favors durability over yield. Third, financial architecture becomes multipolar. This phase rarely triggers public alarm because markets still function. Credit is still available, growth still registers, innovation continues, but capital's objective changes from expansion to protection, from optimization to optionality. This shift explains why capital movements often appear confusing to observers. Why diversify when markets are strong? Why move when valuations are high? Why seek redundancy when efficiency still works? Because institutions do not prepare for today. They prepare for conditions where today's assumptions fail. And those conditions rarely emerge suddenly. They emerge as increasing friction. Liquidity becomes more managed. Debt issuance becomes more frequent. Intervention becomes more normalized. Currency policy becomes more strategic. Geopolitics becomes more economically relevant. None of these alone signal crisis. Together, they signal phase change. This is why analysts studying capital behavior pay close attention to portfolio construction rather than portfolio commentary. What matters is not that firms mention diversification. What matters is where money actually settles. Over time, institutional allocations have shown several consistent shifts. A rising share of capital in real assets, greater exposure to emerging trade corridors, increased emphasis on infrastructure over equities, reduced growth in long-duration sovereign bonds, broader currency distribution, expanded private market positioning. These shifts do not optimize for quarterly performance. They optimize for system navigation. They assume a world where capital mobility, political alignment, and monetary stability are less uniform. They reflect a recognition that the financial environment is becoming less centralized. This recognition is not ideological. It is operational. Asset managers build portfolios that must function across multiple outcomes. They are not allowed to bet on one narrative. They must prepare for inflationary pressure, funding volatility, regulatory fragmentation, trade reconfiguration, currency competition, capital controls, shifting liquidity regimes. These risks are not forecast errors. They are regime risks. And regime risks cannot be diversified away within one system. They require cross-system exposure. This is why the most telling data is not market sentiment. It is market routing, where capital chooses to reside, where liquidity chooses to form, where institutions choose to build infrastructure. When asset managers redirect trillions into international and hard asset frameworks, they are acknowledging that the previous architecture no longer offers sufficient redundancy. They are not predicting collapse. They are planning for transition. Transitions always feel abstract while they are forming, because they occur first in spreadsheets, then in settlement systems, then in capital markets. Only later do they reach public awareness. The silent phase always comes before the visible one, and the silent phase is defined by behavior, not words, not headlines, not commentary, behavior. When the world's largest financial institutions independently converge on similar adjustments, they are not following one another. They are responding to the same underlying incentives. And those incentives arise from structure. Structure determines where capital feels safest. Structure determines which systems deserve concentration. Structure determines when dispersion becomes rational. If capital is dispersing, it is because concentration has become a risk factor, not a benefit. This does not announce collapse. It announces reclassification from unquestioned core to one system among many. Understanding this distinction is critical because when capital begins treating the dominant system as one option rather than the only option, history shows that the final phase is no longer theoretical. It becomes a matter of sequence, and sequence determines impact, which is why the strategic question for business leaders is no longer whether institutions are moving. They are. The strategic question is what this phase historically produces, and how environments change once silent repositioning gives way to overt realignment. That question defines what preparation actually means. By the time financial transitions become visible to the public, strategic positioning is already late. Markets respond quickly, policy responds slowly, institutions respond first. This is why the most important value in analyzing capital behavior is not prediction, it is preparation. The purpose of understanding this phase is not to forecast collapse, dates, or headlines. It is to recognize that the operating environment for capital, business, and investment is changing. And changing environments require different strategies. When systems shift from expansion to preservation, the rules evolve, credit becomes less forgiving, liquidity becomes more selective, valuations become more sensitive, policy becomes more reactive, capital becomes more cautious. In such environments, the businesses that thrive are not the ones optimized for maximum growth under stable conditions. They are the ones built for resilience under variable ones. This is the strategic lens decision makers must adopt. Not fear, not speculation, but structural awareness. Historically, late-stage financial systems do not fail in one motion. They fragment. And fragmentation changes everything. Fragmentation means higher funding costs, more volatile exchange relationships, less predictable regulation, greater political involvement in markets, increasing importance of jurisdiction, rising value of liquidity, declining tolerance for leverage. For business leaders, this alters the foundation of planning. Revenue forecasts become less reliable, cost structures become more exposed to currency shifts, supply chains become more sensitive to financial policy, access to capital becomes more conditional. This is why strategic implications are not limited to investors. They affect operators, executives, entrepreneurs, private business owners, anyone building inside the system. The first implication is balance sheet awareness. In stable expansion phases, leverage amplifies success. In transitional phases, leverage amplifies vulnerability. High debt locks businesses into interest rate risk, refinancing risk, and liquidity dependence. When capital becomes more selective, highly leveraged firms lose flexibility precisely when flexibility becomes most valuable. Strategically, this environment rewards lower fixed financial obligations, stronger cash flow buffers, longer funding runways, reduced refinancing dependency. It penalizes business models that require constant cheap capital to survive. The second implication is liquidity management. In transitional phases, liquidity is not simply cash, it is optionality. Liquidity allows businesses to absorb shocks, negotiate from strength, acquire distressed assets, retain talent, and adapt to sudden changes in demand or regulation. Illiquidity traps businesses inside environments that may deteriorate. This is why institutions increase liquid reserves even when returns fall. They're buying time. Time becomes a competitive advantage. The third implication is geographic sensitivity. In globally integrated systems, businesses often treat jurisdiction as secondary. Late-stage transitions reverse that. Regulatory environments diverge. Tax structures shift. Currency policies become strategic tools. Capital controls become more politically acceptable. Businesses operating across borders must understand that location becomes a financial variable, not only operational. Where revenue is earned, where profits are held, where liabilities are denominated, where supply chains are financed, these decisions increasingly affect survival. Strategic planning now requires jurisdictional risk assessment alongside market analysis. The fourth implication is capital structure alignment. As institutions reposition, the sources of financing evolve. Traditional funding channels may tighten. Alternative capital pools may grow. Strategic partnerships may replace debt issuance. Private capital may become more influential than public markets. Businesses that understand these shifts early can align themselves with the flows of capital rather than competing against them. Those that wait often find themselves refinancing into worse terms, or not refinancing at all. The fifth implication is valuation realism. During expansion phases, asset prices reflect abundance. During transitions, asset prices reflect fragility. Multiples compress. Liquidity premiums rise. Risk premiums widen. Businesses built on perpetual valuation growth face a difficult environment. Those built on durable cash generation gain relative advantage. This shifts strategic emphasis away from narrative-driven growth and toward operational robustness, margin discipline, customer quality, pricing power, supply reliability, cost adaptability. These become decisive. The sixth implication is human capital. Financial transitions strain institutions. They do not eliminate the need for talent. They increase it. Businesses able to attract, retain, and align skilled people gain disproportionate advantage when systems destabilize. This is because complexity increases, and complexity rewards competence. Operational excellence outperforms financial engineering when liquidity becomes selective. The seventh implication is mindset. Late-stage environments punish assumption-based planning. They reward scenario-based planning. Leaders must prepare for multiple outcomes rather than one baseline forecast. Inflationary pressure, deflationary contractions, currency volatility, credit events, policy interventions. Not one will define the environment. The environment will move between them. Strategic planning therefore becomes probabilistic rather than predictive. This is the mindset institutions adopt. They do not choose narratives. They build portfolios of outcomes. This is precisely what capital behavior now reflects. When large institutions reduce concentration and increase optionality, they are expressing a belief that the system is entering a period where variability rises. And variability changes incentives. The goal is no longer to maximize participation in one environment. It is to remain functional across several. This is what serious decision makers must internalize. Not that collapse is imminent, but that uniformity is ending. And uniformity is what made previous strategies reliable. In more fragmented systems, advantage flows to those who maintain financial flexibility, preserve liquidity, reduce dependency, diversify operational exposure, build durable revenue, retain strategic patience. These are not defensive traits. They are transitional traits. They allow businesses to acquire when others retreat, to expand when others consolidate, to negotiate when others depend. Understanding this phase early is not about retreat. It is about positioning. Because when silent repositioning gives way to overt realignment, competitive landscapes change rapidly. Market leaders shift, capital channels reorganize, policy priorities reset, and environments reward those who anticipated structural change rather than those who reacted to headlines. This is why the movement of capital matters. It is not commentary. It is context. And context determines which strategies survive. The institutions have begun adjusting to that context. The question now facing serious decision makers is not whether the environment is changing. It is whether their own structures are prepared to change with it. Because in every financial transition, the greatest risk is not instability, it is rigidity.